More on the Fed and the market takeaways. Let's bring in Jefferies chief market strategist, David Zervos. David, what was your takeaway as it relates to for investors from the Fed chair, particularly that news conference, which seemed to make more headlines around his dovishness?
You know, I wouldn't go so far down the dovish path, Sarah. I think there's a strong commitment to fighting inflation. And I think as we talked about after the June meeting when they did the 75 and kind of really pushed their credibility to, I think, cyclical highs, that they're just, they're warming the market up to the idea of what they have to do, which is be tough, bring demand down to meet these limited supply periods. Hopefully those go away soon. And we're getting closer to the end. And I think the most important thing for the market to take away from this was really that we're moving kind of baby steps away from forward guidance. They could have been more aggressive, and I sort of hoped they would have been, like the ECB did last week, and just say, look, we don't know. We're gonna surprise you, give you a little bit more, and then we're just gonna kind of go meeting by meeting. He did say meeting by meeting, but then he kind of waffled and said, hey, we kind of have this SEP from the last time. That's pretty good guidance. So he hasn't really thrown forward guidance away, but he moved it off to the side, and I think they're getting very close to moving forward guidance completely away and just going, not just saying meeting by meeting, but really having a kind of, an open path forward as opposed to where we are now, which I think is still trying to tell the market, hey, we got a 25 and a 50 and maybe another 25 and another 50 before the end of the year. That's kind of how we see it, but we're just not sure. That's a good step forward. And I think the market likes to see that end game.
Right. Well, he did say that it's not going to be as clear with the guidance now that he says that they're at the neutral point. But then to your point, he did mention the dot plot. Maybe we'll just get rid of that altogether. So what does it all mean for stocks and for bonds and for the dollar, which is increasingly pricing in cuts next year?
Yeah, the cuts are a little perplexing. It's not perplexing in the sense that the market is giving the Fed so much credibility. They're saying, look, as soon as inflation starts to come down, these guys are going to be able to go back to their old ways of cutting rates as things turn down. I'm not sure the Fed's really going to embrace that. So I think those are a little bit premature in there. But we're splitting hairs, 25 or 50 cut next, in the next few quarters of 2023. At the end of the day, I think the story is really one of the Fed having earned the credibility to be able to do that if they need to, and the market giving them that. Whether they take it or not is a debatable point. I think they probably won't. But again, this is all kind of consistent with where you wanted to go in the beginning of the question, Sarah, which is what does it mean for stocks? What it means for stocks is that the Fed is got this credible attack on inflation really under control, and Jay's doing an incredibly good job of massaging long-term yields lower, keeping that yield curve inverted, which I think is a sign of credibility, keeping break-evens on the down trajectory, particularly the forward break-evens, keeping the dollar strong, and getting the market comfortable with a modest slowdown and not an aggressive slowdown, hopefully not a recession, but probably a small recession in the end. He won't admit it, but that's probably where their head is. And we're going to come out of this, with a couple scratches and bruises, but at the end of the day, the stocks had priced in a little more than a few scratches and bruises. So they were priced for a little too much pain. And that's why we're seeing the bounce that we're seeing. And we talked about that bounce last time after the June meeting. You had Gary on, you had me on, and I think you had the guy from Credit Suisse on.
Morgan Stanley, Mike Wilson. Yeah. He wasn't buying it. So you're buying it with Gary this time.
Yeah, you had Gary buying, me switching from selling to buying, and you had the usual bear staying bearish. So I'm sticking with what I said to you last time. I think we made a bit of a turn here. I think we've got a little summer squeeze on our hands. I'm kind of excited about it. And I think it all hinges on the Fed credibly going after inflation and the market feeling comfortable with that move, that it's not going to generate an extraordinarily deep cut, but just a few nicks and bruises.
David Zervos, always good to hear from you, especially on a Fed day. Thank you very much.